Hello, and thank you for tuning in to the Fi Mastery Podcast, where our focus is on providing tools, resources, and insights that empower driven individuals to secure their own path to financial independence. My name is Peter Donisanu, and today we're going to talk about whether a Roth conversion is right for you. Now, let's face it, no one wants to pay any more tax than necessary to the IRS. Yet, more often than not, many high-earning professionals think more about putting money into a Roth IRA than taking advantage of other high-reward, low-hanging savings options. That's why in today's episode, we'll discuss the differences between tax-deferred and tax-free accounts, and when it truly makes sense to put money in a Roth IRA. We'll also discuss one method you can use to calculate the feasibility of completing a Roth conversion and whether it makes sense from a tax perspective. Either way, there's no right answer to this question, but with a little insight, you can make a more informed decision when it comes to contributing to your various retirement savings accounts. So with that, let's dive into today's podcast. A Roth conversion is a critical consideration for many high-earning tech professionals and business owners, but is it right for you? To be sure, as you delve into the work of planning for your financial independence journey, it's essential to understand the intricate balance between taxable and tax-free retirement accounts. And as we pointed out in recent articles, with a strategic approach, you can make the most of your hard-earned money and ensure a comfortable retirement that aligns with your aspirations. But now, at what point should you consider a Roth conversion? Well, picture this. You're diligently setting aside a portion of your earnings in a traditional 401k or a similar tax retirement account. Now, it's a tried and true method offering immediate tax benefits, but there are long-term implications that you may not have considered. For example, as your savings grow, so does the potential tax liability. And from this perspective, then, the question arises, how can you strike a balance between receiving tax advantages today and dealing with a future tax burden? And that's where tax-free retirement savings vehicles like Roth IRAs come into play. That's because with a Roth IRA, you pay taxes on your contributions up front, but the growth and the withdrawals are entirely tax-free in retirement. It's like planting seeds today that will blossom into a tax-smart future. But again, the big question here is this strategy right for you? Should you maximize your 401k contributions to take advantage of immediate tax benefits? Or would it be wiser to prioritize Roth IRA contributions, which offer tax-free growth potential? So then how do you navigate these choices and find your optimal balance? Now, make no mistake, retirement planning is rarely a one-size-fits-all endeavor because it's about crafting a strategy that suits your unique circumstances. That's why, as you embark on your journey of maximizing your retirement savings, understanding the interplay between taxable and tax-free accounts is paramount. And by strategically considering your order of operations, leveraging 401 contributions, evaluating traditional and Roth IRA options, and even delving into the realm of Roth conversions, you can lay a solid foundation for a financially secure future. Now, as you embark on your journey towards financial independence, it's crucial to grasp the distinction between taxable and tax-free retirement contributions. That's because this understanding will empower you to make informed decisions about your savings options, optimize tax efficiency, and potentially enhance the longevity of your retirement savings. Now, to achieve these objectives, one powerful tool at your disposal is a Roth conversion. And before diving into its benefits, let's explore the concept of taxable retirement savings options like 401ks and traditional IRA accounts, as well as your tax-free options like the Roth IRA. That's because by understanding these choices and how they work and differ, you can strategically plan for your future in a more thoughtful manner. So what exactly is a taxable retirement account? Well, in simple terms, it refers to savings accounts like 401ks and traditional IRAs where contributions grow without tax consequences in the present, but future withdrawals are subject to ordinary income tax. And so how does this work with the 401k? Well, as you recall, these types of accounts are employer-sponsored retirement savings programs that enable you to allocate a portion of your pre-tax earnings towards your retirement fund. Now, one notable benefit of these accounts is that the contributions you make to the account are not taxed in the year that the income is earned. And why is this important? Well, it's important because it reduces your taxable income, allowing your savings to grow tax-deferred and potentially reducing your overall income tax liability. What's more, any employer matching contributions effectively yield a 100% return on your own savings. Even so, when it comes time to withdraw funds from your 401k, these distributions are treated as ordinary income and subject to taxation. This makes 401k's tax-deferred accounts, as all distributions are typically taxed upon withdrawal or when required minimum distributions become mandatory. Now, let's shift our focus to the tax-deferred cousin of the 401k, and that's the traditional IRA. Now, similar to a 401k, a traditional IRA allows you to defer tax on contributions made with after-tax income. Now, contributions to this type of account are typically tax-deductible, reducing your taxable income for the year. And like a 401k, capital gains, dividends, and interest earned within a traditional IRA remain largely untaxed until you start withdrawing funds. Even so, upon withdrawal, or when RMDs kick in, the distributions are taxed as regular income, with the tax bracket in retirement determined by your total annual income. All right, now that we've explored tax-deferred accounts, let's turn our attention to tax-free retirement savings options. These options include accounts like Roth IRAs, where contributions are made with after-tax dollars, and withdrawals are completely tax-free. And so, how does a Roth IRA work? Well, as we mentioned earlier, a Roth IRA is funded with after-tax income, meaning you contribute to the account using your take-home pay. And while this may seem less advantageous compared to pre-tax contributions, the real benefit lies in tax-free withdrawals during retirement. That's because as long as the Roth IRA has been open for at least 5 years, and you're at least 59 and a half years old, any distributions you make from this account will be entirely tax-free. And this makes the Roth IRA a compelling choice if you anticipate being in a higher tax bracket during retirement, expect future tax rate increases, or simply want to avoid mandatory distributions altogether. Now, after exploring the differences between taxable or tax-deferred accounts and tax-free accounts, the question remains, how do you decide which account type is right for you? Well, the answer depends on several factors. First, if you anticipate being in a lower tax bracket during retirement compared to your current situation, sticking with a 401k or traditional IRA may be more advantageous. That's because by deferring taxes now and paying a lower tax rate upon withdrawal, you can potentially minimize your overall tax burden. However, if you expect to be in a higher tax bracket in retirement, a Roth IRA becomes a more appealing option. That's because paying taxes upfront allows you to enjoy tax-free withdrawals later, effectively sidestepping potentially higher taxes in the future. Now, it's crucial to note that you don't have to choose one account type exclusively. In fact, a mix of both taxable, tax-deferred, and tax-free retirement accounts can provide optimal flexibility and tax diversification. And this approach can allow you to manage taxable income in retirement and hedge against future changes in tax laws. Indeed, understanding the difference between a taxable, tax-deferred, and tax-free retirement account is a crucial first step when considering the benefits of a Roth conversion. Remember, these types of accounts offer unique advantages and disadvantages, and the right choice depends on your unique individual circumstances, including your income, expected future income, and retirement goals. All right, now that we've discussed the difference between taxable and tax-free accounts, let's review your order of operation when it comes to your savings contributions. Now, just like solving a complex math equation, there's an ideal way to put your income to work before fully converting your savings to a Roth IRA. So then, where should you put your money to work first? Well, when it comes to saving for retirement, your employer-sponsored retirement plan, such as a 401k, can be a potent resource. That's because these plans offer unique advantages that significantly enhance your long-term saving strategy. And as we've mentioned before, one of the biggest benefits is the potential for an employer match to your contributions. Now, this happens when your employer contributes additional money to your 401k based on how much you contribute in the first place. And it's essentially free money, providing an immediate 100% return on your investment that you can't get through other retirement saving strategies. And the fact is that many people leave money on the table every year by not taking full advantage of their employer match. And so why is an employer match so important? Well, let's consider an example to illustrate why matching is so essential. Now, suppose your employer offers a 100% match on your contributions up to 6% of your salary. And if you contribute 6% of your salary, your employer adds in an additional 6% or 100% of your 6% contribution. That's why failing to contribute that 6% in the first place means missing out on that extra 6% from your employer, effectively leaving money on the table. So then from this perspective, the first step in maximizing retirement savings should always be to contribute at least enough to your employer-sponsored retirement plan to fully capture your employer's matching contributions. Now, with all this said, it's worth noting that the IRS sets limits on how much you can contribute to these types of retirement accounts each year. And as of this year, the maximum contribution for a 401k, 403b, or a TSP is $22,500. And if you're aged 50 or older, you can contribute an additional $7,500 per year. And this catch-up contribution is designed to help individuals who are closer to retirement age bolster their savings. So then, if your financial situation permits, consider maximizing your contributions to these accounts up to their limits. Doing so not only allows you to take full advantage of the tax benefits that these plans offer, but can also significantly enhance your long-term savings due to the power of compounding on a pre-tax basis. All right, now that you've taken full advantage of your employer's 401k match or reached your contribution limit, another smart strategy to consider here is funding a traditional IRA. Now, a traditional IRA offers numerous advantages that can help grow your retirement savings more effectively and efficiently. And the primary advantage of a traditional IRA is the tax deductibility of contributions. That's because any money you contribute to a traditional IRA can be deducted from your income for a given tax year, effectively reducing your taxable income. This means you'll owe less income tax, freeing up more of your money for saving or investing. And as of this year, the contribution limit for a traditional IRA is $6,500 per year. And this contribution limit applies collectively to your IRAs, including your traditional and Roth accounts. And while the tax benefits of a traditional IRA are notable, it's crucial to be aware of certain limitations that apply if you or your spouse have a retirement plan at work. That's because the IRS imposes income limits that can reduce or even eliminate your ability to deduct your traditional IRA contributions if you or your spouse are covered by a workplace retirement plan. For example, as of this year, if you're covered by a retirement plan at work, the deduction for contributions to a traditional IRA is phased out for single filers and head of households with incomes between $73,000 and $83,000 per year. And for married couples filing jointly, where the spouse making the IRA contribution is covered by a workplace retirement plan, the income phase-out range is between $116,000 and $136,000 per year. And if you're not covered by a workplace retirement plan, but your spouse is, the deduction is phased out if your combined income is between $204,000 and $214,000. Now, it's important to note that these income ranges are subject to change and can vary from one year to the next, so it's essential to verify the current ranges with the IRS before you decide to make a contribution. So then, if you're eligible, it's wise to contribute the maximum amount to your traditional IRA each year. Doing so provides you with an immediate tax deduction and allows your savings to grow tax deferred over time. This means you won't owe any taxes on your investment earnings until you start taking distributions in retirement, enabling your money to compound more effectively. Now, once you've maximized your contributions to your 401k and traditional IRA, the next logical step in your retirement savings journey is to consider a Roth IRA. Now, while a Roth IRA contribution doesn't provide an immediate tax deduction like a traditional IRA contribution, it still offers several unique benefits that make it a valuable part of a balanced retirement savings strategy. Now, before we talk about these benefits, let's take a step back and recap what makes a Roth different from a traditional IRA or an employer-sponsored plan. Now, unlike a 401k or traditional IRA account, contributions to a Roth IRA are made with after-tax dollars. This means that you pay income tax on the money before contributing it to the account. And while this may seem like a disadvantage compared to a tax-deductible contribution, it still offers a significant payoff down the line in the form of tax-free withdrawals. To be sure, with a Roth IRA, both your contributions and the earnings on those contributions can be withdrawn tax-free during retirement, provided the withdrawals meet certain qualifications. This means that the money you invest in a Roth IRA today could grow substantially over time, and all of that growth will be yours to keep when you retire. Now, as of this year, the Roth IRA contribution limit is the same as that of a traditional IRA, which is $6,500 per year and $7,500 for those aged 50 or over. Even so, with a Roth IRA, it's essential to know that certain income restrictions can limit your ability to put money into these accounts. Now, for those filing single and head of household, the ability to contribute to a Roth IRA begins to be phased out at an income level of around $129,000. And for married couples, this income limit begins at $204,000. Put simply, if you make too much money, more often than not, you likely can't make a direct contribution to a Roth IRA. Even so, the Roth IRA is a powerful retirement savings tool because it allows you to pay taxes now in exchange for tax-free income later. And this can be especially beneficial if you anticipate being in a higher tax bracket in retirement, or if you believe that tax rates are likely to increase in the future. And by contributing to a Roth IRA, you're essentially locking in your current tax rate. This could result in substantial tax savings over the long term, as you won't owe any tax on the growth of your investments when you start taking those distributions. What's more, Roth IRAs aren't subject to required minimum distributions during the account owner's lifetime, unlike traditional IRAs and 401ks. And this flexibility allows you to manage your retirement savings and withdrawal strategy on your terms. All right, so what if you find yourself in a position where you've maximized your contributions to your employer-sponsored plan and have taken full advantage of your traditional IRA, but make too much money to contribute to a Roth IRA? Well, you could consider doing a Roth conversion. And what is a Roth conversion? Well, a Roth conversion is the process of transferring assets from a traditional IRA or a 401k into a Roth account. Now, as we've mentioned before, this is a strategic financial decision that can offer significant tax benefits, enabling you to maximize your retirement savings. Even so, like any other financial decision, it entails complexities and requires careful consideration. Indeed, understanding the benefits of a Roth conversion is just one aspect of the puzzle. To determine if a Roth conversion is the right move for you, you need to compare the cost of conversion, which is essentially paying that tax that you'd owe now, versus the potential benefit, mainly the tax-free withdrawals in the future. And how do you do this comparison? Well, this is where the net present value approach comes into play. Now, the net present value approach is a financial calculation used to determine the present value of an investment while taking into account the time value of money. In essence, it calculates the worth of future cash flows in today's dollars. And when applied to a Roth conversion, the net present value calculation helps compare the current tax cost of the conversion with the present value of future tax-free withdrawals. And so how do we determine if the net present value is good or bad? Well, if the net present value is positive, it suggests that the present value of the future benefits of a Roth IRA outweighs the immediate tax cost, indicating a beneficial conversion. On the other hand, a negative NPV, or net present value, suggests that the conversion may not be as beneficial. Now, we provide a write-up for how to do an NPV calculation for a Roth conversion on our website, FiMastery.com, but the key takeaway here is that the result of doing the calculation will provide you with the net present value of your Roth conversion in today's dollars. And again, a positive NPV suggests that conversion may likely be a good financial decision, while a negative NPV suggests that you may be better off not doing the conversion altogether. Now, make no mistake, the net present value approach is a powerful tool in the decision-making process when considering a Roth IRA conversion. With that said, this approach is not without its complexities, and that's because this approach relies on several estimates and assumptions that can significantly influence the results. Now, one fundamental assumption in the NPV calculation is that current tax laws will remain constant over time. However, as we well know, tax laws are subject to political forces and can change over time. For example, future changes could affect the tax benefits associated with Roth IRAs, such as tax-free distributions, or modified tax rates applicable to traditional IRA distributions. And if income tax rates were to decrease in the future, the tax savings from a Roth conversion likely would be less than what you've estimated with current rates. So here we're specifically talking about the unknowns related to potential changes in tax laws. Now, another factor to consider when conducting conversion analyses is that the trajectory of your future specific tax bracket is largely unknown. Indeed, while determining your current tax rate is relatively straightforward in the present, estimating your future tax bracket can be much more challenging. That's because numerous factors can influence this rate, and many of which are difficult to predict entirely. And these factors can include changes in your income, whether from employment, investments, or retirement distributions, which can significantly impact your future tax bracket. And even your personal circumstances, like a change in marital status, can also alter your future tax liabilities. And finally, another key assumption in the NPV calculation to take into consideration is the discount rate. Now, this rate represents the assumed rate of return on your investments over the long term. And this rate plays a pivotal role in determining the present value of future tax savings or costs. Now, while history is typically a useful indicator of market direction, predicting the rate of return can be challenging due to the variability of market conditions and investment performance. And this uncertainty is a key consideration when performing an NPV analysis because the rate of return significantly influences the results of the NPV calculation. That's because a higher assumed rate of return reduces the present value of future tax payments, making a Roth conversion appear less attractive. Conversely, a lower rate increases the present value of these future tax savings, potentially favoring the conversion overall. Either way, using the NPV approach to evaluate a Roth IRA conversion is a powerful method for understanding the potential long-term financial impact of this decision. However, it's important to remember that this calculation relies on estimates and assumptions that are subject to change. That's why it's essential to consider multiple scenarios and work with a professional who can provide personalized advice based on your specific circumstances. Taken together, in the ever-evolving landscape of preparing for financial independence, the thing that remains constant is the need for a strategic and informed decision-making process. And as high-earning tech professionals and business owners out there, you possess the power to shape your financial destiny and secure a measure of financial independence that reflects your purpose and values. Remember, the path to financial freedom is as unique as your fingerprint. That's why it's essential to understand the intricacies of balancing taxable and tax-free accounts, strategically leveraging your 401k contributions, and making informed choices regarding traditional and Roth IRA contributions. And by using the net present value approach when considering Roth conversions, you can gain a clearer understanding of the potential benefits and make decisions that align with your long-term goals and help ensure that you're making a decision that's right for you. Indeed, by understanding the various trade-offs, considering your order of operations, and harnessing the power of Roth conversions, you'll be well equipped to make confident and informed decisions about your wealth. Even more importantly, doing so will take you one step closer to becoming the master of your own financial independence journey. Well, that's it for now. Thank you for taking the time to listen to the FI Mastery podcast. To learn more about our research, visit us at fimastery.com or email your questions to questions@franklinmadisonadvisors.com. Until next time, I'm Peter Donisanu, wishing you and yours abundant health and prosperity.
FI Mastery Podcast is brought to you by Franklin Madison Advisors, Inc. Franklin Madison Advisors is a registered investment advisor firm with its registration and principal place of business in the Commonwealth of Pennsylvania. Registration of an investment advisor does not imply a certain level of skill or training. This commentary and forecasts are limited to the dissemination of general information pertaining to Franklin Madison Advisors' investment advisory services and general economic and market conditions and are subject to change without notice. The information shared today is not intended to be personal, legal, investment, or tax advice, or a solicitation to buy or sell any security or engage in a particular investment strategy. For additional information about Franklin Madison Advisors, including fees and services, please contact Franklin Madison Advisors or refer to the Investment Advisor public disclosures.